All family businesses engage in capital budgeting, even when they don't realize it. Capital budgeting is simply the process, ideally a disciplined process, for allocating investor capital to productive corporate assets. Capital budgeting is the process by which managers and directors of family businesses fulfill their stewardship role. As stewards of the family's capital, family business managers and directors bear the responsibility of allocating that capital to projects that will provide an attractive risk-adjusted return. But how do managers and directors do that? In our experience, it's best to think of capital budgeting as a continuous process rather than a discrete task. There are 5 basic elements to that process. At the level of a single potential investment, the process starts by identifying the relevant cash flows for the proposed investment. Next, managers use evaluation techniques to assess the financial viability of proposed investments and rank those investments that are competing for scarce investment dollars. But capital is not the only scarce resource for family businesses. So managers should also evaluate non-financial constraints that could affect the company's ability to execute on a proposed investment. Now, financial viability is a necessary but not a sufficient condition for investing in a capital project. Articulating the strategic rationale for the proposed investment is an essential element of selecting the capital investments to be made. And finally, making an investment closes the selection phase of capital budgeting, but opens up the critical but often neglected monitoring phase. Now, let's explore each of those elements in a bit more detail. Relevant cash flows are those that are capable of making a difference in the investment decision. Therefore, when identifying relevant cash flows, we need to learn to think at the margin. What cash flows will change if this investment is made? There are 3 broad groups of relevant cash flows to identify for any proposed capital project: the initial investment, the annual net operating cash flows over the life of the project, and the terminal value, if any, at the end of the project's life. Now, identifying the relevant cash flows does not yet reveal whether a proposed investment is financially viable. Calculating the net present value and internal rate of return for a project allows managers and directors to assess whether a proposed project is viable from a financial perspective. Now, both techniques require a reliable estimate of the cost of capital for the family business. In the NPV technique, the cost of capital serves as the discount rate for calculating the marginal impact on the value of the family business by undertaking a capital project. Alternatively, the internal rate of return on a project is compared to the cost of capital to determine if the project is viable. When capital is scarce, both techniques can be adapted to help managers and directors rank potential projects. In addition to capital constraints, the capital budgeting process should also take limitations on management, infrastructure, and broader capital resources into account in evaluating projects. As the cliche goes, culture eats strategy for breakfast. Now, whether that is actually true is a debate for another day. But it is true that that strategy eats spreadsheets for breakfast. As a result, the capital budgeting process cannot rely exclusively on financial metrics. Projects need to be evaluated relative to the company's strategy. Successful family businesses select investments on the basis of their strategy, rather than constantly shifting their strategy to justify investments. Finally, the capital budgeting process is not complete without a disciplined monitoring, feedback, and benchmarking structure in place. Bad forecasts lead to bad investments. So ongoing monitoring, feedback, and benchmarking is essential to improving performance. Well, thank you for watching, and be sure to check out the links at the bottom for more resources on capital budgeting.